what to do in current scenario when interest rates are rising, especially for mutual fund investors.
Hi, Pavitra and Sonal. Good to be a part of this show. Look, so I think the times in which we are living are unprecedented in many ways, right? We've seen a rate hike of almost 190 bips in last 6 months, from the month of May till date. The repo rates have gone up from 4% to 5.9%. This is unprecedented hike in such a quick time, right? And now what has happened is, because of this rate hike, the transmission of this rate increase has not yet happened to that kind of degree and extent. The corporate borrowing rates, the individual home loan rates, they've all gone up, but not to a massive extent thus far, right? Even the deposit rates at which you book your fixed deposits, they've gone up dramatically, but they haven't gone with a very sharp pace and magnitude. So the times are changing, and they are changing thick and fast. Very soon, within next 6 months on, from here on, we will see the interest rate scenario really hurting each and every aspect of the economy, including the corporate borrowing and the individual borrowings as well, right? So we have to be well prepared to take action accordingly. Given this genesis and given this backdrop, my first viewpoint here is that each investor has to go back to the drawing board and look at the asset allocation once again. If you had decided that your debt equity allocation was, let's say, 40 debt and 60 equity, and for last 1 or 2 years debt hasn't given that kind of returns, and the equity portion has done reasonably well, and suppose, let's say, the equity is now back to 67% by virtue of market movements, then the investors have to actually take action and trim down that 7% additional equity allocation and move back to debt, right? This activity is fairly important, should be done at least 2 times a year. But this being the closer, we are closing towards the calendar year now, so it's better that all investors go back to the drawing board, do this asset allocation, get it right, and it's better to err on the side of caution here. I would rather recommend that you take a cautious view of equity, trim down your equity allocations depending on your asset allocation. Again, I'm not saying go heavily underweight equities, but I'm just saying that get it right and don't go overboard right now, given the rate scenario and given everything else.